All right, good morning, everyone. Thank you so much for joining us. This is the third of 4 planned webinars during the course of 2021 from CalPERS, explaining, previewing, highlighting, and informing stakeholders about our asset liability management process, which we call the ALM. Today's focus is on understanding the discount rate, the decisions that will be coming up in the very near future. My name is David Takearts, and I just want to quickly run you through some of the housekeeping for this. We do have several hundred stakeholders on the line this morning, so that would be pure chaos if we were to unmute the mics for all attendees and take questions that way. Therefore, we urge you to please submit your questions via the chat function on Zoom. You may also see a Q&A function. It would be best if you would do it through the chat. Those actually, for some reason, come through 2 different channels and makes it very difficult to track everything. So go ahead and type your questions in there. Please note, other participants can also see your questions, and we do this so that you are not typing a question while 27 other people type precisely the same question. So that's why you'll be able to see that there. So we're not going to do any kind of voiced questions in. Instead, I'll ask our moderator, Brad Pacheco, to give voice to your questions. The webinar is planned for 90 minutes this morning. We may not need the full time, but we're certainly happy to go that distance. And we're going to have our presenters really go through the full presentation for you so that you can understand the full picture. We've tried to anticipate some questions that may come in throughout and embed the answers within the slides. So stick with us there. So we'll move through the full presentation material and then take questions at the end. However, feel free to type in your questions as we go into the chat function, and the team here will be curating those and getting those to our presenters to answer towards the end. So in the chat function, encourage you to have that up. We will be posting links to various materials that are referenced throughout the webinar. So we'll try to get those to you so that you can easily save and download those. We've already started doing that, as you can see there, as we're providing links to our centralized asset liability management resource page on the CalPERS website. These slides that we're going to cover will be made available to everybody, and we'll send that out right after the webinar is done. So with that, let me go ahead and turn it over to our facilitator for this morning's conversation, the Deputy Executive Officer over Communications and Stakeholder Relations for CalPERS, Brad Pacheco. Go ahead, Brad.
Thanks, David. Good morning, everyone, and welcome to CalPERS webinar on our asset liability management process and discount rate. As David mentioned, my name is Brad Pacheco. I'll be serving as your moderator today. David mentioned this is the third in a series of educational sessions that we are hosting to share the process and the data that makes up our review of our investment portfolio and associated discount rate. I noticed a question in the chat about our previous sessions, and they are available if you'd like to watch them on our website. If you've joined us for those earlier webinars, we welcome you back. Some of today's information may already be familiar to you, but we feel it's important to remind everyone where we've been in this process, where we're at today, and what's to come. And if you're joining us for the first time, welcome, and we thank you for taking time out today to be here, and we hope through this presentation and any questions that you have that you'll walk away with a better understanding of how we balance our assets and liabilities to fund the system. So joining me today is our Chief Financial Officer, Michael Cohen, our Chief Actuary, Scott Turando, and our Managing Investment Director, Sterling Gunn. And I'd like to just kind of walk through what we plan to cover during our agenda. Of course, we will walk through the process of our asset liability management review. We're also going to look at our funding risk mitigation policy that was recently triggered due to the 21.3% investment return, and that automatically lowers the discount rate based on different thresholds. So we'll go through that and talk to you about what the discount rate looks like today. We'll just do an overview of what is a discount rate, what its impacts are to both employer and employee contributions, and how the pension industry is approaching the review of the discount rate. And we'll look at other viewpoints, other pension funds that have made changes recently. You'll see a map of different states and where their associated discount rates are. And then we'll talk through the capital market assumptions. We've done our own survey of industry experts, and we want to provide you the results of that survey and what the capital market assumptions are looking at. And then we'll wrap up the presentation with just the timeline of this process and what you can expect is coming forward to our board for recommendations and approval later this fall. So with that, I'd like to turn it over to Michael Cohen to get us started. So Michael.
Thank you, Brad, and good morning, everybody. As Brad mentioned, many of you have already heard many of the overview process of the ALM, the Asset Liability Management. But for those of you who are new, just a quick review. Really, this is a once every 4-year process where we're, in essence, kicking the tires on all of the underlying assumptions of the pension fund with the long-term goal of making sure that the fund is sustainable and that everyone who has worked in public service in California for many years get the pension that they've been promised. So ultimately, though, that is a balancing act. It's a balancing act on sort of the cost that employers pay, the cost that employees pay, the investments that are earned by the system. And so it's really sort of, a balancing act in terms of looking at the liability side, which is more the actuarial office, and then, and then the asset side, which is our investment office, which right now we have roughly $475 billion under management. And so we take a look at all of these assumptions in terms of our earning potential long-term, as well as how our liabilities are looking. We sort of review all of the underlying assumptions and all of that. And the ultimate outcome of the ALM process is the discount rate. And that fundamentally is the most important number of the pension system, because it really ties to what we think we can earn long-term. And we'll get into that more in a little bit. So if we go to the next slide, we can start looking at where we've been so far. So this is a year-long process. You see the shaded out months starting in February earlier this year, and then what's coming up the rest of this calendar year. Fundamentally, what we've done today is really lay the groundwork for some important decisions the board's making. Really, this is, if not the most important, one of the most important decisions our CalPERS Board of Administration will make in the foreseeable future. So ultimately, what we've done is kind of do an economic review, a review of the capital market assumptions. We'll go through those in some more detail in a few minutes. And then coming up will be September and November, where really the meat of the ALM process occurs. So first of all, we'll get into candidate portfolios. We'll talk about those more. That's really on the investment side. And then on the actuarial side, the experience study that looks at the demographics and our actuarial assumptions. And then ultimately that comes after the September discussion items, we move to November, where the decisions at this point in time are lined up to be made by our board. And then once there is a decision in terms of our investment strategy and our asset allocation, those things don't happen overnight. You can't sort of flip the switch and suddenly change hundreds of billions of dollars of investment strategies. So we do take a number of months to implement the strategy, and basically by next summer, next July, is when we really say that's the effective date of our new strategic allocation. So that's sort of the calendar coming up. This is kind of an overview of more detail of what we're going to get to in the coming minutes. And then if we can go to the next slide, really, we've been thrown a wrinkle, a good wrinkle this year from our funding risk mitigation policy. This was a policy put in place in 2015 by our board that was really looking ahead and realizing long-term the outlook for investment returns was not nearly as rosy as the decades prior. And they were concerned about the volatility that even with these lower expectations, our investment strategy was going to be. So what they decided to do was really, rather than implement any dramatic changes all at once, they looked to a more gradual strategy. And rather than just doing it at that point in time in 2015, they said it would be best to use good fiscal years, good return years to, in essence, buy down the discount rate. So as of last year, we were at a 7% discount rate, but under the policy you see here, basically more and more as we were over the 7%, starting at 9%, we would lower the discount rate in increments of 5 basis points, 0.05%. So you see, because we ended up with 21% returns this past fiscal year, we're in the band between the 13 and the 17 percentage points above the 7% discount rate. And so we end up with a 6.8% discount rate. So as of today, CalPERS going forward has a 6.8% discount rate. That's basically the new baseline for the system. If we go ahead and go to the next slide, the wrinkle I mentioned is that this policy was put in place without really factoring in that, hey, the risk mitigation policy could be triggered in the year of the asset liability management process. And so because of that, we basically have this two-stage process. We've lowered the baseline to 6.8%, but that's only the start of the decision-making process I already gave you the overview of. So we're not going to make any changes based on the 6.8% until the end of the ALM process. And so while the discount rate has shifted, we're still going through all of the same analytical process that we've planned for this entire year. And it certainly it's created a little bit of confusion, but ultimately I think it's a good thing that it's giving everyone an opportunity to see how the risk mitigation policy is working in its first year, at the same time that the decisions laid out in the policy are not final until our board sort of finalizes the asset liability management process, as I said, towards the end of the calendar year. So with that, let me turn it over to our Chief Actuary, Scott Tarando, who will run through more on the implementation of the discount rate and the risk mitigation policy.
Thank you, Michael, and good morning, everyone. If you look at the slide in front of you, what's graphed out or what's displayed here is kind of like a timeline of, where things have been and where things will go in the future in terms of implementation. And if you look right now, we're just we just started August. The capital market assumptions were adopted, or not really adopted, but presented to the board last month, and we have a return for the year. And as you can see, going forward in September and November, we'll be presenting candidate portfolios and making decisions not only on asset allocation and discount rate, but also decisions on new demographic assumptions that will be used in the actual valuation. So when you look at this, it's kind of broken up into two different pieces here, state and schools in the first section, and then in the purple here, public employers. And so, what Michael mentioned, and I've seen it, I saw a question came up, when will these be effective? We've gone over this before, but it's somewhat confusing. So we're stepping through it here again. And what will happen is any changes due to discount rate, assumption changes, risk mitigation policy, any of those results will be reflected in the 6/30/2021 valuations. Now, those valuations are issued in the 2022 year. So any current valuations coming out this year will not reflect any of these changes that we're talking about right now. And when those valuations come out in early throughout the 2022 year, you can see for state and schools, it's effective for fiscal year 22-23. And then there's a longer delay for public agencies, and any changes reflected throughout this process, you'll first see the impact on your contributions in the fiscal year 23-24. Next slide.
Scott, thanks for addressing that question. And I'll just, there's one other question we can just get an answer in there, and that was how often we do this ALM process. And the answer there is every 4 years. We
go through it every 4 years. If you go back several years, a fair amount of time, the asset allocation was changed every 3 years. The actual assumptions were every 4 years, and we synced them up several cycles ago, so everything made sense, and all the changes occurred at the same time. So following this slide, we're going to run through, some of you have possibly seen these examples before, but we're going to run through some examples of the risk mitigation policy in terms of contributions. But, we want to remind everyone that, it's just the risk mitigation policy's first step. The board's going to be looking at additional asset allocation changes, and there's an associated discount rate with those choices, as well as demographic changes for all the plans. And those demographic changes can and have had, I'd say, substantial impact on rates in the past. Going back several years ago, the CalPERS system got returns in excess of over 20%. And the demographic changes pretty much offset those gains. So as we're working through these changes, I want to make it clear that the discount rate is just one portion. There are other pieces that will come out throughout the ALM process, and just letting people be aware of that. Next slide. Thanks. As you can see here, a lot of you have probably seen this. What we have here is a baseline contribution rates for a sample city miscellaneous plan. As you can see, the baseline is in black, and the rates had been projected to go up a few years, kind of come down, level off, and work its way down over the next 20 years. After the 21.3% return, you can see the large drop. It's illustrated in the blue line. It goes down fairly substantially, and then kind of follows the same pattern and levels out eventually after 20 years. With the risk mitigation policy, there's kind of like a balance. We drop the discount rate, and we use some of the gain from the investment side to offset any increases that would have normally occurred from dropping the discount rate. So what we end up is kind of like splitting where we were and where we would have been. And you can see the orange line kind of just pretty much splits those two lines pretty much all the way over the next 20 years. Next slide. This is an example for the safety plan, similar situation. The results are a bit higher for safety just because the safety plans have higher contribution levels, but you can see the shapes are the same, and the resulting impact of the risk mitigation is the same, where we pretty much split the rates between where we were before the 21% return and after the 21% return. Next slide. This slide generated a lot of questions last time, so we're going to step through it again and go over some examples. Now, when PEPRA came into effect, one part of it was that any PEPRA member would be required to pay half the normal cost. And as we drop the discount rate and make a change to a discount rate, there will be an increase in the normal cost. So when you kind of step through here, in the first example, we have what we call the base rate. The base rate is the last time the PEPRA employee contribution rate was set. So you can see we have the base rate and we have the employee rate. Then you see the discount rate example here, 7%, the rates are a little bit different, but you can see the employee rate is still the same. When we drop the discount rate in this example of 6.8, you can see there was a fairly modest change. The change in the normal cost, was less than 1% from the 7% discount rate. You have to go all the way back to what was the base rate. The base rate was 13.5 in this example. So you can see the increase between the 13.5 and the 15.1 was greater than 1%. When we have a greater than a 1% increase in the normal cost, the employee contribution rate is increased to half of the new normal cost. So in this example, the employee rate jumped from 6.75 to a 7.75. Example 2, we kind of run through the same example where the base rate's a little bit different. Instead of it being 13.5, it's 14.2. And following the same process, you can see at the end, we have the discount with a discount rate of 6.8, same normal cost 15.1, but the increase from the base rate is less than 1%. And in this case, the employee rates remain the same at 7%. Now, I in terms of where you find this information, there's a PEPRA section in your valuation reports. It goes through, it lists all the details on how your particular PEPRA employee normal cost rates were calculated. It listed the base rates as well, and they're both in the pooled and non-pooled. So if you're wondering where do I find this information, it's published every year and updated every year in the valuation report.
Scott, while we're on this slide, a question came in. It says if PEPRA employees pay half and the discount rate is increasing the normal cost to 15.10%, shouldn't the employees pay 7.55%, not 7.5%?
Yeah, so with that, there's also the caveat that the employee contribution rates rounded to the nearest 0.25%, and it's rounded down. So in this case, the 7.55, as someone mentioned, 7.55 would be half, but it gets rounded down to 7.5.
Thanks, Scott.
Sure. I saw there was another question. What year is the base normal rate from? It depends on, it really depends on the last time the employee, we had to make a change to the employee PEPRA contribution. It is not the same year. It's not like the year gets locked in. Obviously, when PEPRA first was implemented, everyone had the base year of 2013. At that point, any changes through demographic changes or discount rate changes that we did in 2017 would have changed those base rate years. And you'll have to go look to your report to see exactly which year it applies to you. I'm also seeing a question, will the increased PEPRA rates for municipalities see this change in 722 or 723? It would be, if you remember the slide back on page 10, I think it was page 10, any change that we do through this ALM process will be reflected in the 23-24 rate, if I got that right. You could go back to page 10 and see. I just 23-24. Yes, that's correct.
Scott, where would employers find the base rate in their report?
There's a section in the report. It says PEPRA normal cost. It varies on page number. If you go to the table of contents, it says it's towards the latter part of the report. It's towards, so if you just go down through the table of contents and look through, you'll see where it says PEPRA normal cost, and you can just go to that section and open it up on the report.
And Scott, I know we'll move on here in just a second, but there's a couple other questions that came in. These might be more on the administrative side, but the employer asks, we currently deduct 7% from our PEPRA members through our payroll process. Does this mean we will need to increase that amount to 7.5%? And if so, will there be a communication from CalPERS?
Yeah, so what happens is when the annual valuations come out every, say, summer for the public agencies, and just kind of an aside, the valuations should be coming out either later this week or early next week for the 6/30/2020 valuations. So when those come out, you know, there's a cover letters and there's notices where if there's a change in the PEPRA rate, we let people know that there's been a change in the PEPRA rate. We also send out a number of circular letters and notices to employers to take a look at your report and see whether your PEPRA rates are changed. And then you would have to make corresponding changes to your payroll deduction. Now, I also see there's a question, could there 1% trigger a decrease in PEPRA rate? The answer is yes. Obviously, if we, by decreasing the discount rate, costs are going up. But say we made some demographic assumption changes through the ALM process and the normal cost comes down. If the normal cost comes down more than 1% from the base, then yes, the PEPRA normal cost could come down as well.
Great, thanks, Scott. I think we're good on those questions, so we'll let you move on.
All right, so we'll move on to the discount rate. On the next slide. Now, we've mentioned discount rate a lot throughout all of these webinars, and you know, sitting down here, maybe it's a good idea if we sit and kind of define and explain kind of what we mean by discount rate. So if you look here, we have a number of points here on the slide. At the top, you know, discount rate's technically defined in the PERL, you know, very specifically. You know, it's an interest rate fixed by the board for purposes of actual valuation of assets and liabilities. I mean, that sounds great, and you know, but you know, it kind of doesn't tell you what it is. You know, if you think about it, the discount rate, you know, it's the rate we use to discount the expected future value of pension plans or pension plan payments. It's generally, most people, you can think about it as the expected investment return. It doesn't have to equal the expected investment return, but for CalPERS, we've treated those two numbers as the same. A big influence on the discount rate is capital market assumptions. Where do we see expected returns throughout the various asset classes? And also, it also depends on the asset allocation that the board will eventually make a decision on. So it's a combination of, you know, expectations on your demographic population, expectations on your investment returns, asset allocations, and all those three or various pieces are put together and combined. So we use that process to develop the discount rate. Next slide. And then finally, here's kind of a history of the CalPERS discount rate. And you can see going back 20 years, just over 20 years, our discount rate was 8.25. It was dropped to 7.75. We had it at 7.75 for 8 to 9 years, somewhere around that. And then we dropped it to 7.5. And you can see most recently, we dropped it over the last ALM cycle. You know, we dropped it in stages down to 7%. You know, as you know, something to keep in mind when you're looking at this chart, our 20-year return was 6.9%. So if you drew a line at 6.9%, you would see a discount rate that's been assumed for the last 20 years has actually been above our return that we've gotten throughout the last 20 years. You know, some of that helps contribute to why we're still underfunded, why rates continue to go up. That's basically because discount rate for the last 20 years has been too high. Those type of questions come up and people say, well, our discount rate's 7, we're 6.9, aren't how come we're underfunded? This kind of shows why we're underfunded. The discount rate for the last 20 years has been too high. And with that, I'll pass on to Sterling with the next slide.
Sterling, I don't think we're hearing you. Are you on mute? No, we don't seem to have your audio. I'm going to ask David Takearts to see if he is able to do anything in the background.
Brad, he is showing as unmuted right now, so I believe it may just be a technical issue with the mic device at his station, unfortunately. Sterling,
Okay.
can you want to log off real quick and log back in and see if that corrects?
And I can probably sort of do a layman summary of the slides
Right.
until Sterling comes back. So
Thanks, Michael.
sure. So this next slide and then the one after that are pretty similar. And basically, this one's a little confusing, but it's delivering the same message that, in essence, the reason that the discount rate has been coming down over time is the dotted black line. That's the 10-year Treasury rate. So that sort of in the way I think about the 10-year Treasury rate is, okay, what can we invest with little to zero risk? And so you see years ago, we were able to basically earn quite a nice return on those 10-year Treasuries, even above our discount rate, which is the orange line. And so that made achieving our expected returns incredibly easy, right? As long as the federal government was good on the 10-year Treasuries, then we were going to meet our return. But over the last number of decades, that has diminished quite a bit. Now, it's almost near zero. And so over time, basically, CalPERS has had to take on more and more risk in its investment strategy in order to continue to meet its discount rate. And the difference between the blue and the gray shading in the background of this chart is basically the higher risk investments and the lower risk investments, the lower risk being the gray. And so you see the gray shading shrinking over time and the blue shading going up. And so that's as there's been less and less sort of risk-free returns, we've gone to other measures trying to generate good long-term returns. And that, of course, comes with volatility. The more risks you take in your investment strategy, the more volatility you're going to have. So why don't we go ahead and go on to the next slide. And so this is sort of a simplified version of the prior chart, basically showing that 10-year risk-free yield and the discount rate. So isolating just two of those lines, and you see the gap used to be a positive gap. So as I mentioned, basically, we could achieve our result just buying 10-year treasuries. And then over time in 2020, it's gone down and down and down to where now there's a gap of 5.4%. So we basically need to earn 5.4% above risk-free investments in order to hit our discount rate. So why don't we go ahead and go to the next slide. This sort of is sort of making a similar point from the Oxford economics folks in terms of that the long-term expectation of global gross domestic product growth is going down over time. And so, and that means that, again, that our investment strategy requires more risk to get the same level of returns. You sort of see here the overall average is the arrow, the orange line, and then the ups and downs are the just year by year returns, which obviously we have a lot of volatility in the global economy, but then the 10-year average is slowly going down. Even though we had a slight uptick a few years ago, it's now sort of hitting the long-term downward trend that other national and international economists are expecting for the foreseeable future, all the way into the next several decades. So if we go to the next slide. So this one, I think we've really covered through Scott's examples, but basically the impact of lowering the discount rate raises the cost to the system. But there is the difference between Classic and PEPRA members. So Classic members don't have a share of cost when the discount rate goes down. That falls entirely on government employers. And that was one of the big changes made by PEPRA, passed by the legislature in 2012 and implemented for new employees hired in 2013 and beyond. Basically, PEPRA employees, as we've talked through, share a cost of the overall normal cost. And the normal cost is only a piece of the system. It's, sort of for many agencies, the smaller component of their overall rate. You've got the normal cost, which is the annual expenses, and the unfunded liability, the UAL, as shown on this slide. And that one is the UAL, both for PEPRA and for Classic members, is borne entirely by the employer. So as a discount rate goes down, you have no change in the normal cost for Classic employees. You might have a change for PEPRA employees, but you definitely have a change on the employer side of things with the unfunded liability costing more long-term. So if we go to the next slide.
And Michael, I think we have Sterling by phone now, so we'll
okay, great.
test that out and turn to him. Can we hear you, Sterling? Let me see. I think, can we unmute him, his phone line, David?
There we go.
All right, there we go, Sterling. We can hear you now.
Wonderful. And thank you, Michael, for walking us through the first part here. So in terms of what other experts are saying, so if you just go to the next slide, please. In June and in July, we had the privilege of having a number of external speakers come to the board and talk quite a bit about the external environment. And there's a few key takeaways. And I'll get to the numbers that are in front of us in a second. One, there is a diversity of opinion about the future. And we will accommodate that diversity by using different scenarios and so on to understand how whatever portfolio we propose will perform under different circumstances. But it is important to keep track of that. The next message was that expected returns are lower going forward than they have been in the past. And you see that in the page in front of us here, where we have the history of past returns and what we think going forward. The particular numbers here, the 4.2% for a U.S. equity total return. Again, that is a number. There's a diversity of opinion, but the opinion holds that over, whatever view they hold, it is lower going forward than in the past. And the other part of the key messages there was that risk is likely to be higher. So if we go to the next slide, please. So this is a summary that Goldman Sachs sort of led to us in June. And these are some of the factors that they're looking at. And just, visually, you can kind of see there seems to be a lot more sort of downside to the world than upside. Some of the factors are probably more important than others. But this does also reflect the fact that the environment we're in is highly uncertain. Certainly more uncertain than it had been, say, 10 years ago. We've seen new fiscal policy, we've seen geopolitical situations. So there are a lot of things going on in the world that will affect returns. Next slide, please. So this is an example of what we presented to the board in July. If you had the privilege of or the good fortune of seeing that presentation in July. Some of this might make sense. Broadly speaking, though, the dark and gray boxes and the light blue boxes are the range of estimates provided by the survey results that we had available to us in July. So I'll just pick an example on the very left-hand side where you can see global equity. So the dark box is the range from our survey results of March of 2020. And the light blue box is the range of results from December of 2020. So you see a few things. You see, first of all, that the overall range narrowed a little bit. That's true. But you'll also see, if you look at the white circle, that was the median from March of 2020, and the green diamond is the median from December. So the median returns actually dropped, and they dropped significantly over that 9-month period. So if you're going across the asset classes, that's the general trend, and that's what we were observing, that the return projections or expected returns are lower than they used to be. And even with the March survey results, although they bounced back a little bit, they are still low. They are certainly low compared to 4, 5, or 10 years ago. And Scott made that observation earlier about our discount rate and how the discount rate tended to have been higher than our return projections, and that sort of contributed to the current funding status. So we're working very hard here, again, to explore the range of outcomes and appreciate the uncertainty that's actually involved in this process of trying to understand 20-year returns. I think that's all I'd like to say on this slide. So this is sort of comparing what would happen with the current portfolio. So back in 2017, there was an expected return, if we look at 10-year expectations, of 6.1%. And if we look at the bottom panel, for the ALM in 2017, there was an expected return of 7% and a volatility, which we call expected risk here, of 11.4%. Well, if we take that same portfolio from 4 years ago and ask, okay, what would it have looked like last March of 2020? Well, the 20-year expectations had dropped to 6.6%. The expected risk had dropped a little bit to 10.5. And if we now then move forward 1 year to March of this year, we see expected returns have come up to 6.2%, and the risk has come back up to about the same level. So what's the overall effect? Over the last 4 years, expected returns have dropped. Risk has remained about the same, but higher than it was even a year ago, but the same as 4 years ago. So the overall message is the current portfolio really doesn't have a great expectation of delivering the 7% we thought it might 4 years ago. And so this is where the ALM process, this review every 4 years, is a way of updating the portfolio in order to try to deliver whatever target returns we're asked to deliver. Next slide. So I think I hand this back to, is it Michael?
Sure, thanks, Sterling. So this chart is really a global map, or I should say a national map of just the acknowledgement that other pension funds are doing what CalPERS has done over the last number of years. So you see quite a few of the pension systems have basically been in the process of lowering the discount rates. They're all looking at the exact same experts. They're helped by the same consultants. They're doing the same type of surveys, and they're all looking at the same information. So ultimately, boards have to make decisions that meet their fiduciary responsibility to their retirees. And so that's sort of the trend that you're seeing on this map. Over time, this has really been a trend nationally, not just in the orange highlighted states. So why don't we go to the next one? So what's next in the ALM process? This is kind of wrapping things up in terms of what you're going to see in September. So sort of a preview of the type of information that will be in front of our board. It's September 13th and 14th are the key days of the ALM presentation. So this first slide will be in the investment committee on the Monday, September 13th. Really, you'll see the investment team put forward a range of investment portfolios, as Sterling mentioned, starting with really what our current asset allocation is, and then go more aggressive from there. So sort of that 6.2 range that you just saw on the previous slide, and then increase allocations to more aggressive investment classes. And each of those portfolios that are presented have attached discount rates to them. So when you basically average out, okay, that we expect private equity to earn this percentage, we expect public equity to earn another percentage, we expect our sort of risk-free investments to earn this lower percentage, you average all of that together and end up with the discount rate associated with a particular portfolio. Some of the portfolios are going to add in those investment strategies that we've been talking about the last several years that are sort of the effort to be more aggressive in earning long-term returns. And you've heard, for those of you who have followed CalPERS over the last couple of years, you've heard our investment team talk about private equity, direct lending, and leverage. Those are things that we've talked to our board about and in varying forms had approval to move forward with strategies to get more aggressive in these areas. We've done some of this for a long time historically, but going more aggressive into these areas comes with greater risk as well as greater noise, that these areas tend to have, more attention on them. And so we want our board to understand the trade-offs involved. And ultimately, all of these candidate portfolios are about trade-offs, that you can't get something for nothing. You're not going to be able to get 7.5 or 8% returns without higher risk and higher volatility. And so we'll show the range that we think are reasonable within our current portfolio, what it means to change, what are some of the options to be more aggressive to get higher numbers. But ultimately, those things do lead to the higher risk and higher volatility. So you'll see us talk about that for any candidate portfolio, it has an associated volatility and an associated risk that the system or an individual plan might run into trouble. So that's the investment committee on Monday, September 13th. Why don't we go to the next slide, which is really turning to the actuarial side of things, and that's on Tuesday in our finance and administrative committee. So this is really the experience study that Scott's team is in charge of and are working towards finalizing now. So again, as Scott mentioned, we do these things every 4 years. And basically this is a check on life expectancy, salaries, inflation, disability rates, retirement rates, how early people are retiring or how late people are retiring in life. All of these assumptions are baked into the actuarial valuations that have been coming out each of the last 4 years, but this is our opportunity to just check on, okay, what's our experience from the last 4 years? Does it match up with our assumptions? And if not, actuarially, we need to adjust the assumptions to match the experience. And so ultimately, as we saw, say, 8 years ago, when Scott's team made life expectancy changes, they can have somewhat significant effects on the normal cost. And ultimately, all of these assumptions are going to affect the normal cost as well as the unfunded liability based on leading into the discount rate. And so you have the same types of effects that we talked about earlier, where some PEPRA members may be affected by these things, but the classic members on the normal cost wouldn't be affected. Ultimately, you have factors that may be going in opposite directions, and Scott will be presenting those to the Finance and Admin Committee on Tuesday, September 14th. So with that, that's kind of really more detail on what to expect at the September meeting. I'll turn it back to Brad to bring us to the finish line on the presentation.
Thanks, Michael. And while we have you, why don't we just ask the question here that is in the chat about portfolio options. The question is, when will they be available to the public for review? And I think what you said is they would be at the investment committee on September 13th. We do post our agenda items prior to that, so the assumption would be about a week prior they'd be available. Is that correct?
That's correct, yes. And everything goes public on our homepage for the board meeting agendas.
Great, thank you. So we'll just wrap up here. And if you do have any questions, I'll just ask now if you could put those in the chat and we'll get to those. And I know we have a couple that we've missed, so I want to get back to those. This is the timeline that Michael shared with you at the top of our presentation. And again, he has indicated and stressed that really the key dates here for us are September and November, when this information is going to be presented to the board. And ultimately, if we stick to our current timeline, the recommendations around the asset allocation and discount rate would be in November. We've been providing these educational sessions to provide this information and answer your questions, but what's really important to us and what's important to our board is that your voices are heard throughout this process. And we do virtual board meetings, as most organizations do today, but we do have a phone number. If you want to provide public comment, we'll make sure our stakeholder relations team gets that to you. And we encourage you to, virtually attend both of these meetings and provide any comment that you have. The next slide, please. And that's basically where we're at with questions and answers. So let me go back to one question that I saw earlier, I think that we had overlooked. And Scott, this was really around, let me see if I can find it here quickly as I scroll through. It was around demographics and when we'll be taking those into account. Sorry here. Scott, when do you present your experience study while I look for this question?
We have a first reading in September on the Tuesday of that week.
Okay.
I think Michael says 14th. I don't have the exact date, but yeah, he's nodding his head. So it's 14th. That's the first reading in September. So basically the board's going to be seeing, the asset side on Monday and liability side impacts on Tuesday. And this is in September. Then we come back in November for final approval and board selection on the asset side.
Thanks, Scott. And I found the question. It's will the recently announced life expectancy reduction for both males and females have an effect on the rate calculation?
No, because there's a couple of factors. When we looked at our data set only goes through 6/30/2020 in terms of reviewing information. So it doesn't include anything after that. And when we look at the experience, we look at overall experience. I mean, we look at long-term trends, not any particular short-term deviations. So we look at the trends over the last decade or so in terms of where things are, and we also look at where our population as a whole is. So while you may be seeing increases in mortality, that's those increases are increases in the general mortality for the general population versus CalPERS is a specific group of retirees and basically if you look at our system, we overall have better our people live longer and we have better mortality than the overall general population throughout the country. So you're going to see differences. And while there may be life expectations may be dropping in across the country, overall, it may not apply necessarily to our population. So, that's the analysis we do every 4 years. And when we do, the current ALM doesn't reflect any of that. When we do 4 years from now, we'll be looking at those trends and seeing if it was a short-term deviation or there's longer-term impacts.
Great, thank you, Scott. So this next question, I'm not sure this is one that CalPERS necessarily has a perspective, but I'm going to throw this to Michael because he used to run the Department of Finance. And the question is, as we continue to to describe increasing inequities in the impacts of these policy changes on Classic and PEPRA employees. Does CalPERS have any guidance on potential ways to introduce more equity into the numbers through labor negotiations, recognizing it's a subject to meet and confer?
Sure. Thanks, Brad. And it's certainly a difficult topic. And you sort of hinted at, no, CalPERS isn't going to get in the middle of bargaining. We really don't see that as our role. You've seen over time the evolution of CalPERS, sort of what its role is viewed as. And right now, I would say we're really focused on the effective and efficient administration of the system itself. And what PEPRA did is really standardize benefits across all jurisdictions, whereas back pre-PEPRA, you had a lot of competition among jurisdictions trying to recruit and retain. And so you had different benefit levels for pensions, depending on which jurisdiction you were in. And what PEPRA did was standardize it. But obviously, what that does create some confusion and tension between Classic and PEPRA employees. That eventually will, sort of wash out as the entire system is PEPRA employees. Roughly now, across many plans, it's 50-50 in terms of Classic versus PEPRA members. But just to get back to the original core of the question, no, CalPERS will not be sort of inserting ourselves into collective bargaining. We'll certainly provide any facts and information that can be helpful, but ultimately it's going to be up to each jurisdiction to figure out what makes sense to talk to their employees about their particular situations.
Yeah, thank you, Michael. And this next question, we understand this is a difficult topic, and I really open it to Michael, Sterling, or Scott to chime in. So it's for cities and counties out there who have residents that they're serving. Obviously, it's a difficult situation to explain when our investments outperform and perform very well, 21.3%, but costs are still going up because the discount rate has been lowered. And maybe you can give your perspective, the panelists can chime in on how we can message this to California citizens as to why this is important and how it's going to stabilize the fund over the long term.
Sure, let me take the first shot and let others jump in after me. I think, Brad, your last comment really hits at the heart of the way I would frame it, is that this is really about the long-term sustainability of the fund, and that costs are going to go up before they start going down. PEPRA was really designed around a very long-term systemic change in the system, but that we're still looking at the same facts that the board saw when they put in the risk mitigation policy, which is the outlook for the future keeps getting diminished. Now, just because we had a 21% return doesn't mean we're going to get a 21% return next year or the year after that. And so it's really there is some cognitive dissonance between sort of what we're seeing long-term versus what we just saw this past year. But ultimately, the increasing costs, I should say, the costs aren't going to necessarily increase, and in most cases, they won't increase across jurisdictions. The risk mitigation policy was designed to sort of share roughly half and half between lowering the discount rate and lowering overall rates. And so for most jurisdictions, their unfunded liability is going to be affected, but the great 21% return will lower the long-term projection. So if you go back to the chart, the line graphs that Scott presented, you sort of still see rates coming down. So hopefully many of your jurisdictions won't even sort of notice the change, and they will see lowering rates. And I think that's probably where I'll stop. And if Scott wants to, or Sterling, kind of add in any other thoughts.
It sounds like maybe you covered it there. So thank you, Michael. Oh, go ahead, Sterling. I think I heard you start to speak.
So I think Michael covered all the bases. with respect to this sort of 20+ return over the last year, my analogy is like when you come across a $20 bill on the sidewalk, pick it up, put it in your pocket, and bank it, which is sort of what the risk mitigation policy is actually doing.
Yeah, thank you. Scott, there's a question here. I think it really applies to any employer that's listening. What advice would you give employers to estimate the impacts to their particular city or county, knowing that we have our pension outlook tool out there?
Yeah, so there's two methods of doing it. You can, as you mentioned, they could use the pension outlook tool, go out there and just change the discount rate, and they will get an estimate of what the change in the liabilities are and the impact on contribution rates. And you can do that through the pension outlook tool. You could also, if you're more old school, grab our report. If you look in the report, we do sensitivity analysis where we change the discount rate. We look at plus and minus 1% as an example, and you can see it. If the change, for 100 basis point, and we, in the report, there's 100 basis point change impact on the normal cost and the unfunded liability. And then you could, prorate that if you wanted a 50 basis points or a 20 basis point change. Now, that's kind of why we went to the tool. You can get out the calculator and make those calculations yourself. This avoids, potential errors that people might, inadvertently introduce when they do the calculations themselves. So, if they're both out there, you can use both methods. The tool's a little bit simpler and safer. You just change the discount rate and you can see the impact directly. And then in terms of the portfolios, when we come in September, there's going to be cost impacts of those portfolios. So when we present the range of portfolios for each portfolio, there's going to be the associated risk associated with those portfolios, as well as any potential cost impacts on plans. So the board has a full picture of what each portfolio brings with it.
And Scott, the pension outlook tool, it is available for pooled plans, correct?
Yeah, it's both pooled, non-pooled are available. Right now, it's based on 6/19 results, the 2019 results. The 20 results are just going to be coming out, and once we finalize those results, we'll be looking to update the pension outlook to be based on those results as well.
So just to piggyback on that, the 21.3% return that we just had, is it factored into the outlook tool, or is that something that they would have to manually do?
They would have to do that right now, because once we have the 20 results loaded, it'll be a lot simpler. If you're just looking for impacts on what would the impact on the changing the discount rate on the liability, those you could put in, those would be fairly accurate.
Okay, thanks, Scott. And I did see a question here about our September and November meetings. Would they be in person? And no, unfortunately, possibly November, but at this time, September will be a virtual board meeting, and you can go to our website and watch it there. You can also find that phone number that I mentioned to dial into if you have any public comment. And if the environment changes and we're able to go back into our buildings in November, we'll let you know, and then they would be in person. But that would be the earliest, would be November. Another question, Scott, I think you mentioned this near the top of the program. When will the June 2020 valuation reports be available?
The safe answer will be next week. We are hopeful if everything goes smoothly to get them in possibly by the end of this week. But, I'm not going to promise that they will be in. If you go in on Friday and they're not there. So, expect them next week, sometime next week, possibly a bit earlier. And I'm sure we will send out some kind of employer bulletin or email on that once they are available.
Okay, thank you. And we can have our stakeholder relations team email our attendees on this webinar when they're available as well. Question back on our risk mitigation policy. Let's just assume that the board in November selects a portfolio with an expected return of 6.5% and drops the discount rate to 6.5%. Will the risk mitigation policy be in effect to reduce the discount rate again if we were to earn above 7% this next fiscal year?
Sure. Let me take that one. So as it stands now, the risk mitigation policy is supposed to be reviewed periodically. And so we'll be doing that sort of at the end of the ALM process. But the policy is in effect as of now, and it's not really tied to a particular discount rate. So unless the board takes an action to suspend it, which it did do back in the 2016, 2017 timeline when we were lowering down to 7%, then it would be in effect. But as I mentioned, the board at the last time a discount rate was reduced, this policy was suspended, so you wouldn't sort of have a doubling up of discount rate reductions.
Thanks, Michael. And earlier we talked about the impact of the risk mitigation policy lowering the discount rate to 6.8% and how that has an effect on PEPRA member employee contributions. And the question here is, does it also affect classic members' employee rate contributions? I believe the answer is no, but I'll defer to the experts.
Yeah, that's correct. Classic members' rates aren't affected by really anything going on with the ALM cycle or the discount.
Okay, thanks, Michael. And I guess sticking with the risk mitigation policy, does it have a floor for the discount rate? In other words, how long can the discount rate go based on double-digit returns in any given year? Can it ever reach 5%?
There's no particular floor in the policy. That said, there is a maximum reduction of 25 basis points in a particular year. So to get from 6.8 down to 5, you would need basically, multiple 25% return years in a row. And as I mentioned, the board sort of periodically will review the policy. So if that became sort of unnecessary based on the overall discount rate being low enough that our investment strategy meets the desires of the board, then they would be easily able to amend or suspend the policy.
Great, thanks, Michael. So I'm going to ask one last time if there's any further questions, if you could put those in the chat box. I believe we've covered most of those, but I want to make sure that we didn't miss any. So we'll just give folks about 30 seconds to add anything in there. And I see a couple coming in. What is the link to the discount rate tool? I believe that you're referring to the Pension Outlook tool, which can be found on our website. If you go to the employer section of our website, there's a tab for members and employers. Go there, you can find the Pension Outlook tool there. And my colleague just inserted it into the chat box as well. And the question, one additional question, at 6.5% discount rate, would the total employer rate still be better than the baseline without the 21.3%? Do you see that question, Scott?
Yeah, it depends. And it depends on whether it's miscellaneous or safety. And whether it basically comes down to your current funded status now, your benefit form and your benefit formula. Because as you drop the discount rate, the cost for, say, CHP and safety plans are going to be higher than miscellaneous plans. So you're going to get to you will get into a situation where it may be even for one set of plans, but a cost for another set of plans, or costs are still coming down depending on how you want to look at it. But right now, most plans, around 6.8%, most costs continue, or most plans are continuing to see decreases in cost. If you got down to 6.5, it would possibly be even for some plans, and maybe cost, or there's still going to be possibly costs coming down. There's not a easy answer to that question. There's not a specific answer. It's just, it really depends on the plan specifics at that point.
Great, thank you, Scott. So I see one final question here, and I think it's important that we be clear about what's being presented here. Someone asked, I've heard a recommendation of 6.75% and 6.8% for the discount rate. Which is it? And I'll defer to Michael, but the risk mitigation policy has lowered the discount rate to 6.8%, but recommendations won't be presented until November. Is that correct, Michael?
That's correct. And so 6.8 is the current baseline discount rate under the risk mitigation policy, as we've talked about. And then what we'll do in September, just to restate, is we'll present a range of candidate portfolios, basically a range of options to the board, get their feedback in September, and then based on that feedback, we'll present something more refined come November. But at this point, 6.8 is the only, it's not a recommendation, it's sort of under board policy. It is the discount rate. And, at this point, that's the only number that is kind of out there. We'll present a range around that 6.8 in the September board meeting.
Great, thank you very much. So I'm not seeing any new questions. I see a question here about the pension tool, and we'll make sure to, well, actually we have a couple here. Yes, around the pension tool, we'll get an answer there on how you can input the 21.3% return to calculate some of the impacts. So with that, if we didn't get to any questions today that we may have overlooked, please reach out to our stakeholder relations team, and we'll make sure to get answers to you. Again, this webinar, it's being recorded. It will be available and posted to our website in the next couple days, and you can review the past webinars on our website. And of course, we encourage you to attend virtually our September and November board meetings, and make sure your voices are heard there. It's very important to us and important to our board. So I want to thank Michael today, Sterling, and Scott for all the information. And we look forward to talking to you very soon, and please stay safe out there. Thank you.
Thank you, Brad.